Welcome to the Grow Your Money podcast, where we're on a mission to change how we talk about money. Our fireside chats are the heart of our show, bringing the energy and excitement of in-person events straight to your ears. We aim to connect you with inspiring voices and stories that matter, sharing relatable experiences and insights that will transform your financial life. Everyone deserves access to practical financial knowledge, so we're making money conversations relatable by inviting guests from all walks of life to share their real-life experiences with money. But this isn't your typical money show. We look at the emotional, psychological, and cultural factors that shape our relationship with money. So hit subscribe and join us for another episode of the Grow Your Money podcast.
Hello, everyone. So happy to be here today with a very amazing panel. I am really looking forward to this conversation. I'll let everyone introduce themselves, different backgrounds, different approaches, but today we are going to be looking at the whole thing around credit scoring and how it can work for you as a consumer. We'll start with you, John. If you want to introduce yourself and what you do, that would be awesome.
Yeah, of course. So I am John Webb and I work for Experian. We're a data and technology company, which most people will probably know us as the credit reference agency, one of three in the UK. And I work in our consumer affairs team, which delivers public education. So it's my job to go out and about and help people just understand a little bit more about credit scores, things like ID fraud, how to apply for credit, mostly just guide people around how to improve their credit scores so that, when the time comes, when they want something like a mortgage, a loan, car finance, that they're in the best place to get that. And we do a lot of outreach work with the free debt advice sector, with organisations like the NHS, with schools for education, and so on. So we do a lot of work to just help the public understand a little bit more about credit scores.
Nice. So good to meet you. And you are, if anyone is looking for a credit score, the first thing you always think about is, someone like Experian. So it's going to be
Well,
a
I'd
very
love to
interesting
hear that. That's good.
conversation. Yeah. And then I'll move on to Shona. If you tell us a bit about yourself and what you do.
Hi, I'm Shiona. I'm the CEO of MoneyLine, which is a not-for-profit lender, or CDFI, and we lend to the lowest income households in the UK, and we've been doing this for over 20 years. Our customers are people who wouldn't be able to get credit from a bank, and are often even too high risk for a credit union. And they tend to just need a small loan for something like an unexpected bill or to spread the cost of something like a washing machine.
Important work. Very succinct response. Thank you. And Daniel, please tell us about you and what you do.
Yeah, thanks, Tina, and nice to meet you, John and Shona. It's really a pleasure to sit with you. I'm the co-founder and CEO of a FinTech named Rangeteller. Rangeteller is a framework for lenders to create and assess transparent lending strategies without increasing risk. It's particularly proficient and excels in identifying creditworthy borrowers that are usually missed by credit score rating systems and traditional decisioning tools. One bank we recently worked with has identified that 55% of the people they previously rejected are now in fact creditworthy. So some of the KPIs that are indicated from that are that we identified over 6,000 people from 11,000 that were previously rejected. That's the 55%. And they've been able to go back and retarget them with new loans of up to $4 million of loans to unrepresented people.
Thank you so much. So it's a very interesting panel, and I think the first thing we need to get into is what even a credit score is, because I moved to the UK about 18 years ago, and I was coming from a country that is cash based. So credit was a no-no. Not just was it a no-no, but you just don't have a credit history. It's like, what are you talking about? Borrowing is frowned upon, and you typically work with cash, right? So that cash based society. And boy, was I in for a hard learning curve, trying to understand the system, trying to do things differently. I mean, something as simple as being on the electoral was like, I don't want to do that. So let's just go a bit into what our credit score is. John, do you want to start off? And then maybe we can also look at, from Daniel and Shona's point of view, what they see credit scoring doing for their clients or their solutions.
Yeah, sure. So, well, I'll try and split this a little bit to the credit score and the credit report, albeit we'll probably talk about lending decisions a bit later, because the credit score, it's a numerical value that summarizes your creditworthiness. It's a really complicated way of saying all of your information on your credit report, which just summarizes what shows all of your past borrowing, your bank accounts, credit cards, loans, mortgages, whether you, like you said, whether you are on the electoral roll, if you've got any court judgments, all of that information together, usually for 6 years of history, is pulled together, and that is given a number from a credit reference agency like Experian that says, okay, your score is this. It's a representation of how well that is performing, but really what that means is, how will a lender judge the information on your credit report? What will a lender say, or what will they kind of look at is in terms of risk when they look at your credit report information and say, okay, you've done really well at managing your credit. You might have low outstanding borrowing. You've made all your payments on time. You're registered on the electoral roll. That looks great. On the other side, if you have missed payments, if you have court judgments, default accounts, anything that's negative, for example, then that will usually result in a lower score. And what that means really is the higher your score, the more likely a lender is to give you credit, to give you an account that you want. And the lower your score is, the more difficult it is to get credit, at least at good rates, and good rates being, the interest rate that you pay or the limits you want for a credit card. So really your score, if you think about it quite simply, is a credit reference agency will give you your score. It's just a number that says this is really how a lender will judge you and the information on your credit report when you apply for credit. However, I'm sure we'll talk about it slightly later, is when you apply for credit, there's a slightly different process the lender will go through to, do a full assessment when you apply. So it's just part of the decision, the information on your credit report.
Thank you. That's a very succinct response. I suppose my question to just a short follow-up, John, is that's all well and good, and it makes sense when it's absolutely makes sense to have some sort of scoring system. But I wonder how cognizant you are of the, people with thin credit files, or someone like in my situation when I was new to the country, people of color, for example, have this like inherent biases. Are you guys aware of that? And is there anything you're doing in that sphere to try and make that more aligned or fairer for people who are new, or the inherent biases in data?
Yeah, so it's always a challenge. I mean, not just if you're new to the UK, but anyone in the UK who's just turned 18, for example.
Yes.
We have lots of people who move to the UK, and people who have just got to a certain point and they have never really used credit or have any information on there. And so that's really the start of their credit journey to build up. What we actually say is, if you're in that position and you have almost nothing on your credit report, we call them credit invisibles, because that does make them kind of excluded from mainstream finance because they have such little information. So really what we want to do is just help people take the journey of how did they start building from nothing to then building a healthy credit score that at least puts them in the best place to then access financial products that they want. And the other thing that we have done to kind of move people or help people in that kind of direction is we have something called Experian Boost, which is if you pay for certain things which are typically not included on credit reports. And what I mean by that is it's council tax, it's digital subscriptions like Netflix, Amazon, Spotify, all of those kinds of things, and also if you pay anything to regular savings account as well, then you can use that. That's it's a free addition to what we provide, and it means that you can boost your credit score. I think it's up to 101 points by making any regular payments to those, which is a reflection of a lender will see that you're making regular payments, which helps really your kind of affordability and creditworthiness to say that you are doing that on a regular basis, which is great. And the other thing that we do as well to help is we have something called the rental exchange, where you can record rental data. The opposite to that being that you have a mortgage that goes onto your credit report, And you get a lot of credit for having a mortgage. It improves your credit score. It's a huge monthly expense, but rent typically was never included in credit reports. So now you can self-report your rent information to Experian. And that also means that you're given the opportunity for a large monthly outlay to be included in the data on your credit report to kind of help start that process of building more information. The more information, especially when you're making your payments on time, is great. That's really, where you kind of do, you get the extra points and the extra credit when you go to a lender and they can see it when you apply for something.
That's a very helpful response. Thank you, John. And Sean, I wanted to just find out how credit ratings and that play into your clients, and what your experience is with them.
Yes, so for us, most of our customers have a very, very low credit score. And when we talk about credit score, I think it's important to know that there's not just one credit score as well. So when we talk about a low credit score, that's the main credit score that you see with the credit reference agencies when you look up things like Clear Score or Credit Karma. That's what we'd call the main credit score. So that's not much good to us for our customers because many of them pay for things in cash. Many are renters. Many have in budget weekly rather than monthly, so can't make every payment on time. So we use another credit score, which is still provided by the reference agencies, but it's more suited to short-term credit. So I think it's really important to understand that there's more than one credit score. And another reason we don't use the main credit score is actually, really interestingly, as a high-cost credit provider, customers that make every single payment on time to MoneyLine, it will still be negatively seen on their main credit score by some agencies because they've taken out short-term lending at a high cost. So regardless of making all those payments, they're actually being negatively impacted on that main credit score. So I think it's really about understanding what credit score the people are using, and that depends on the different kinds of credit you're going for. But for our customer, we know that main credit score isn't going to be a good reflection of their financial lives.
So actually, there's a good point if I can jump in, which is because I thought we'd come on to this, which is actually just around lender scores and credit reference agency scores, because Shiona, you mentioned them there. So importantly, there are 3 credit reference agencies in the UK. There's Experian, there's Equifax and TransUnion. You will get a score from each of them, and the score will be different in each of them. We all calculate things slightly differently, and we all have a slightly different banding as well. Experian's up to 999, for example. And so when you look at your credit score, hopefully with all 3 credit reference agencies, then you get an idea of where you fit in that banding for each one. But then, the point raised about, applying for credit is when you apply, I said earlier that the credit report just forms part of that lending decision. So when you apply, they'll look at the information on your credit report, but typically, and that's different for some lenders, and Shiona, you'll know this, but typically they will also look at your application form details, which is really your affordability, salary, dependents, expenses, things like that. And they'll also look at any existing information they have. So if you're already a customer, they'll already have information about how you run the accounts. Now, when you do that and you apply, they take those 3 bits of information together and they will calculate their own credit score for you. Now, that's the score, and they won't usually tell you what this is. In fact, they almost never will. But that's the score that determines whether or not it's accepted or not, and also what the interest rate is, what the credit limit is, and those kinds of things. So that's why, kind of as I said earlier, you just detach slightly the score that you get from a credit reference agency. It's a really good guide to tell you how a lender will view your credit report information. But when you apply, there's other bits of information that are taken into account as well.
Sorry, can I just clarify something there? Because I guess you're right, a lot of it talk about a lender credit score, but I was actually talking about the credit reference agencies having different credit scores. So we don't use the main credit score. We use a different credit score provided by a credit reference agency, more suitable to short-term loan products. So I think it's about trying to understand that not everybody will use that main credit score from a credit reference agency as well. There are different credit scores within agencies that they can use depending on the product and the lender, then take that and create their own lending score as well. So it's a really complex thing because, as you say, there's a lot of different information points that can go in there.
And I think it's a minefield for a consumer. Like if you're a consumer just trying to get by, John, you talked about even when you're going to uni or you just finished uni, it's such a minefield. And so from a consumer point of view, you don't know what to do. Am I going with this credit score? What am I doing with it? But the other thing that I noticed, and a lot of our clients come to us saying, is that I've been doing everything I'm supposed to do according to what the credit agencies are telling me, but sometimes my score is even going down. So I've signed up on the register, I've done XYZ. The credit score rating was 100 or 99, but it's now going down to 80, and I've not done anything at all to affect it. And so it's this whole minefield from a consumer point of view. I wonder if you can speak to that a bit, and if you don't mind responding to that, any of you who know the response to that. And then Daniel, I would want to know how you got into the space and picked up on, the credit referencing.
So I'll maybe jump in first about the score calculation. So there's lots of different things that impact your credit score. So actually, well, two things. First, because Shiona, you mentioned a couple of things. So like, for example, if customers use ClearScore, for example, or Credit Karma. So it's important that people just know where they're getting their information from, because the three credit reference agencies are, as I said, Experian, Equifax, and TransUnion. Now, there are lots of free providers where you can go and get information. You can get your free credit report and credit score as well. Absolutely fine. Just make sure you know where you're getting your credit score from, because if you're checking 2 or 3 different providers, but they're all giving you your Equifax credit score, then actually you're not seeing your score report across all 3 agencies. So that's just important for people to think about when they're doing that.
And so, sorry, John. So, and how do you know? So if I go, how do I know where I'm getting where they're picking their credit report from? Do they say?
Well, they'll tell you on there where they get it from. As an easy rule of thumb, you can come directly to Experian to get your free credit score and get your free credit report as well. ClearScore is Equifax and Credit Karma is TransUnion. They're probably the 3 bases you can cover, but you can go directly to all 3 credit reference agencies if you want to as well. And they all do something called your free statutory credit report. So you can always get a version of that free credit report just to see all the information that they have on you. But the question about the score is, it's quite complicated, the way the score is calculated. And I would generally say the score will always fluctuate. It will go up and down because it depends on so many factors, but particularly things like whether you've opened up a new account. It will drop your score slightly for 6 to 12 months until it recovers and there's a history of making your payments on time. If you take out a new loan, for example, or a credit card that you've got that you spend, you suddenly increase the balance on or get close to your credit limit, it will impact your credit score. So it will always fluctuate slightly. I think it's important just to probably always look at the trend. Nothing happens super fast in credit scoring world. So, when you're trying to build it, you're looking at probably 12 months onwards to start building a really healthy credit score. So you just kind of keep an eye on the trend. If your score's going up over time, that's probably good. If it's not, then you start looking at how can I improve that? It might be things like bringing down the balance on a credit card that might be close to the credit limit, for example, or maybe you have just overall outstanding debt that needs to be reduced over time as well. Always easy things to say because not everyone has the means to just pay off a credit card. But it's just, if you know that that's probably the thing that has to happen to improve your credit score, then you can kind of work at it over time and chip away at debts that might be impacting your credit score.
Thank you. That's very helpful, actually, because again, when you're looking at all the third-party providers, it's better marketing, better whatever the case may be. You don't understand the complexities of it, so you're getting 3 different credit scores. You don't know why. So that's a very helpful response. And Daniel,
it's good to check. It's good to check across all 3, and I would recommend anyone to check their credit report with all 3 agencies on an annual basis. And partly the reason to do that is that applications for credit stay for 1 year. And so keeping an eye out every year, and that's just to make sure nothing untoward has happened. So there's no applications in your name that you haven't made, for example, which could mean you're a victim of ID fraud. And if there are, just contact us, and we'll help someone go through that journey to rectify it. And it also just keeps an eye on where you are and so on. So it's just I would say once a year, and like I said, you do it for free. Have a check-in, see where you are and where you stand, and just check the information. But I'd probably say actually don't overcomplicate it. So although there's 3 agencies and 3 scores, you can kind of keep an eye on where your score is and just check your reports, but don't get too worked up about the nitty-gritty of everything that's happening with all 3 agencies, with your scores going up and down, how everything is calculated, because generally the rules are fairly much the same across all 3, which is it's based on risk, it's based on how you manage your credit. So things like paying your bills on time will impact your score. Being in debt will impact your score. Being registered on the electoral roll will, and maxing out credit cards will. And if you kind of get to know these general rules, then your score will improve, or should improve, across all 3 credit reference agencies.
Thank you. And Daniel, so you're running a fintech business that's in this space. What led you to do that? And how do you feel like you complement the landscape? Because as John has explained, and what Shiona was saying, it's a minefield, and I think the more solutions that we can try to resolve, the better. So what led you to do Rangeteller, and what does your solution complement?
Yeah, definitely. Firstly, John, Shiona, Tynah, you've kicked this off marvelously. You've unboxed and unraveled lots of information, and it's a real hot topic to discuss. In terms of Rangeteller, we're a fintech that really built and devised our idea from years and years of working in finance, many years of which we worked in algo trading. I'm not sure if any of you know, but in algo trading, when you're building trading portfolios, you need 3 essential elements. You need a machine learning element. You need the ability to incorporate your knowledge and experience on every trade, and you need transparency. You need to understand when a trade is made, what's gone into that. So we built some code that solved a general problem within algo trading, but we saw that it could be used for analyzing lending portfolios. So whereas the credit score is, sorry, you hear me, Tynah?
Yes, I hear you, but I wanted to just jump in and ask you to clarify what algo trading is briefly, just so that everyone's following.
Sure. Algo trading is using sophisticated algorithms and models to help you build trading portfolios automatically instead of manually. So using very complex mathematical equations and models to support you in building your trading portfolios. The point
initially.
I'm sorry?
That's what you were building for initially.
Initially, we saw that there was a problem there, and we built that we needed a system to allow us to see what went into the trades. So some knowledge about what went into it, the ability to adjust them, the ability to blend human knowledge and experience in trading with a machine learning element, which was non-existent. So we did that, and then we saw that it was something that would serve a use case in analyzing lending portfolios, whereas credit scores are massively important, like John said, and it's very important not just for the consumer but the lender to really pay attention to them, and not just one, but really look at the lay of the land and the people that are offering different scores out there. Like Shiona, for example, has one specific one that looks at the subprime, people with thin or low credit profiles. But I think what's important to know is that Rangeteller doesn't analyze on our own data like a credit bureau would do. They have their own data sets and models that build a score for consumers or borrowers. We actually allow you to use our framework on local data. So our framework is a system which allows banks and lenders to create and assess transparent lending strategies. And I think the very special thing about it and groundbreaking thing about it is it allows you to always adjust the strategy or rebalance the strategy and see what the outcome would be.
Interesting. And I think leading into that, Shona, you mentioned something about your clients would actually, their credit score would go lower from taking out products with you. But the fact of the matter is there's some clients that need that resource. They need the services you offer. How does someone get off the hamster wheel? How do you, as an organization, ensure that, your lending practices are fair and equitable? But I think more importantly, how do I come off the hamster wheel of needing your service but needing to improve my credit score?
I think that's a really difficult one, as I say, because our product actually reduces your credit score. And I think there's a balance to be had with people taking credit and credit products to improve their credit score over time and choosing the credit products that they need and that offer the variables that they need. So, for example, for our customers, often cash customers tend to budget weekly. A product holiday over Christmas is really important for them, so we build that into our product. A self-cure period where they maybe have 5 days to pay after their due date, and as long as they pay it in that time, we see that as paid on time. So I think actually, while it's good to think about your future and your credit score, getting the right product that suits your needs, I think, is really important as well. Else you would end up getting into a cycle, as you say, you taking out a credit card that you might not need and then actually making sure you're doing the right ratio of balance to repayment and things like that. So I think it's understanding what you're trying to build your credit score for. Obviously, if you're wanting a mortgage in the future or a bank loan, then it's really important to build that credit score. But if you're somebody who always lives in rented accommodation, maybe moves quite a lot, so staying on the electoral roll, staying in an address long enough, does want short-term credit, buy now, pay later, things like that, it's going to be really hard to build your credit score to get into a stage of needing a mortgage. So I think it's about understanding what you want out of it and then building around that, but almost don't stray away from matching getting the products you need rather than just taking out credit to build a credit score. I think is really important.
Mm-hmm. And I think if you're like people who are prone to like predatory lending, you're better off going to someone that's safe and regulated than, going to that last option. John, I was really intrigued by the whole bit about renters being able to report the data to go towards a credit score. That's intriguing. And I mean, even clear from this conversation, there's so much to unpack with credit scoring. So I feel like education, and again, I'm biased, education is like I just believe in financial education and that sort of thing. What do you guys at Experian do on that front? Are you open to collaborations with financial educators and community organizations? And what initiatives do you have in place to support that education of the consumer? Because it's such a minefield that definitely needs all hands on deck.
Yeah, so I mean, we've kind of in this part of this, conversation, we've obviously uncovered lots of things that, points to discuss around credit scores and what they mean and how they work and so on. So we know it's slightly complex and slightly misunderstood at times, particularly around myths around credit and so on. But we do a lot of work both from a consumer guide and interaction perspective, and also from an education perspective as well. So we kind of tackle it on a few fronts. Now, obviously, as a company, we have our product which we give to customers, so they can get their free credit score, they can get their free credit report, and then if they go online, they can get a whole host of guides and information and video content around credit scores and what that means and how to improve your credit score, how to build your credit score from scratch. And but we do lots of other work around education as well. And my team at Consumer Affairs, although I have not been doing it for that long, but it's been around for kind of 20, 25 years, where we've been running quite a heavy program of outreach to various organizations around the UK. Now, that's particularly with the free debt advice sector. We work heavily with to help educate advisors around credit scores, what they mean, and they can then help clients who are suffering with financial difficulties around what that means as well, and possibly alleviate concerns around getting free debt help and the impact on credit scores, because that can sometimes be a barrier that they think that they will negatively impact their score by getting help. We do lots of outreach work with the NHS, with high schools. We have a really good program which is run by our Experian Black professionals, which is delivering a lesson called What's the Score, which is an interactive thing for I say kids, but 14 years plus, and teaching them the kind of basics around credit scores as well. But so we focus heavily on educating the public as much as possible. We know there's always lots to do, and there's always lots of people we need to reach, and to kind of help guide them in the right direction around credit scores and credit reports and so on. So that's why we kind of continue the work that we do.
Thank you. That's a good answer. And that's intriguing about that program. I didn't know. How do people access it?
So we deliver it, mostly delivered through our Black professionals, which is a group at Experian, and we tend to partner with schools and mostly around the kind of Nottinghamshire area, but we do deliver it in other locations as well. So we'll have people partly through our social impact team, where we can make connections with different schools and different organisations and so on to come out. But of course, we can always we're always looking for new communities and new groups to kind of help deliver that as well. So we're always open to hearing if anyone has any people that would like to have a kind of credit score basic session, and it's quite a fun one. And I say that because I designed it myself, and it's you kind of work through characters and work out what their scores are, what loans they can apply for, and how much those loans cost in interest rates. So it kind of sets the scene around what credit scores mean, and then how much you actually pay for loans if you don't have a good credit score, or if you do have a good credit score. So it's quite good.
Interesting. And then I have to get onto the question of AI. Daniel, you seem the guy for this one. How do you see the lending landscape changing? Because again, maybe it's a misconception, but you always think about your credit score closer to the time when you're trying to borrow money, get onto the property ladder, pay outstanding debt. How do you see the landscape changing and the role of AI and modern technology taking over?
Well, it does get thrown around a lot, the word AI, and it's kind of a marketing and buzzword, and I think we have to be careful how we use it. However, it is the future, and we believe that Rangeteller owns and possesses a piece of AI that could form and mold the future of lending decisions. I think the feedback we're getting from the market is that they're desperate and demanding for more flexible tools. So not just use the credit score. It's very powerful, like John said, but using other systems to complement it. As he mentioned, at the moment, it's complementary to use TransUnion or Equifax or Experian together, but there's a wide array of tools out there that have emerged since 1989 from the US credit score, the FICO score. But the feedback we're getting is that AI has a massive role here, and using an approach that's multidimensional as opposed to just one-dimensional score, Daniel is or isn't creditworthy, take it or leave it, is something that that is going to help shape the future for borrowers, particularly unrepresented people from diverse backgrounds.
Yes, and it's interesting what Shiona talked about, having the different credit scores and even as an organization using different ones. But I want to get into the topic of predatory lending, because people who are vulnerable or typically underrepresented are more likely to be succumb to predatory lending. Shiona, do you want to tell us a bit about what predatory lending is, how we could avoid it, and then I would like all of us to have a slight chat around what, as a consumer, I could do to make my chances better generally at borrowing well, just a healthy lifestyle to improve my credit score as a whole.
Excellent, of course. And actually this ties in very nicely because I was at the 20th anniversary of the Scottish Illegal Money Lending Unit yesterday, which unfortunately they did a great job, but still on the increase is illegal money lending at the moment. Illegal money lending, I think the first thing to say about it is, or predatory lending, is that actually isn't just about somebody on the corner of a street giving out cash, which it used to be. They used to, somebody outside the post office that would be collecting the benefit books, the child benefit books, the pension books. It's moved on a lot from there. It's in the workplace, with predatory lending in the workplace, giving out loans to people in the workplace. It's in vans that come along and park up in a housing estate and have all the kids' toys in the back of them, and then come and ask you for money. It's in bank accounts and by text rather than just in cash. So there's lots and lots of different illegal money lenders, and it isn't just people with baseball bats coming round to your door like you see on the TV. But unfortunately, for a lot of people, the consequences is just that you get tied into a cycle of repaying because there's generally no set interest rate. They're just trying to get you into a cycle of paying a weekly income for them. So I think one of the key things of why it's so successful and why it's growing is because there's very few barriers, with people especially who have a low digital footprint or are cash customers, lack of direct debit payments, things like that, thin credit file. It's very hard to get credit now, and the short-term credit market especially has deteriorated hugely over the last few years. So it's easy to get illegal money lending compared to actually getting legal credit. So I think that's the first thing.
Sorry to interject, Shona. Is this because people, like you mentioned before, these unrepresented people with thin or low credit profiles are somewhat desperate because they can't get it because they don't fit within a score?
Yeah, absolutely. And sometimes we think it's desperate, but sometimes it's about what you know. So, for example, in some areas, it will be a whole family who's used illegal money lenders, and therefore it's a learned behaviour to go and use an illegal money lender because they know that's the easiest way as well. So there's quite a lot of education needed to actually understand and explain that these are illegal money lenders and there is more responsible lenders out there. But it's to do with credit score, it's to do with automation, and that many people don't fit the automation process, especially if you are a cash customer. And there's 5 to 6% of the UK still pay their bills by cash. And when I say cash, I'm talking about PayPoint and things like that as well, but not by direct debit. So there's lots of different barriers. Most of our customers don't have a driving license or a passport. So actually, some of the things just to get a bank account would be very difficult. So there's lots of things that add up to that. But actually, the first thing is, to understand that there is organisations out there. There's CDFIs like us, or not-for-profit lenders, and credit unions as well, who often deal with customers who maybe aren't as digitally engaged and are actually based in the community as well. But I think the first thing is to raise awareness because, as I say, it's often just inherent in the communities that you live in and learn from everybody around about you, because to them, and as long as you pay them back, it's a service that they need.
And what happens if I come to you and I'm rejected for a loan as well? That pushes me back. So what do you do for clients who wouldn't meet the criteria even for your organization to avoid that cycle or that proneness to the predatory lending?
Yeah, absolutely. It's something we've focused on more and more in the last year because 19 out of 20 new customers that come to us, we actually decline through seeing signs of financial distress on their credit report, seeing lack of affordability, or seeing signs of gambling is a growing issue that we see on bank statements. So there's lots of different reasons that we decline. So for that 19 out of 20, they need a solution. And for many lenders, it used to just be let's signpost to everybody to the advice sector. But we all know that the advice sector is overwhelmed. There's long waiting lists, and also they can't solve all problems. And for some people, all they need is a little bit of signposting there and then. So we've been working with Invest, who's a software provider, and an income maximisation tool software support to build a money toolkit. And so when people are declined, they'll go to that. And we focus on giving them signposting, which will take away that need for cash that they have right there and then. They don't really care about something that's going to help them 3 or 4 weeks down the line. So we have to stop the cycle of debt from somebody who's declined. It's about ensuring that they have something that can help them there and then, or else they will go to legal money lenders or very, very high cost lenders. So that is something we're focusing on, and also trying to champion that all lenders do something like that. And it is income maximisation is great, but that's a long-term to mid-term solution for someone. We need to take away the need for cash right there and then.
Mm-hmm. Thank you. That's really good. John, any final thoughts or advice for someone that's trying to build their credit or maintain a good credit score? And I'll ask each of you for a final piece of advice for the listeners on how to navigate finances as a whole, because the credit score, I suppose, is just that starting conversation, but there are many other things that come out of it.
So I think we'll treat it quite broadly. So we'll say, we talk in general rules around improving your score or, building your credit score. So I would say this: if you're in a position where you have very little information, or you just need to improve your credit score, then generally follow some basic principles, which are get registered on the electoral roll if you can. And if you can't, you can add a note to your credit reports called a notice of correction that just explains you can't register on the electoral roll, but you can prove your identity. So they'll come to ask you for some documents and so on. So that's the first thing. And getting a bank account, doesn't matter if it's got an overdraft or not, but if you get a bank account, great. And just make sure you don't go over any unarranged borrowing on it. And then the third part, which is, one of the best ways to build your credit score, is to get a credit card. So this requires self-control because you have to use it in the right way. And that is, you get a card, and often if you've got very little information, you get something which is called a credit builder card. Now, it's very high interest. So what really you would be thinking about using this card for is you pop to the shop and you're going to buy, some bread and milk and bananas because you're very healthy. And you put that on your credit card, so a few pounds once every month, and you pay it off in full every single month, and then you don't pay the interest. What I'm saying is buy something that you would have bought anyway for a very nominal amount, and it keeps the card active, keeps the balance very low, and that's a great way to improve your credit score. Now, the other things to do are, thinking about that is, if you've got a credit card, don't max it out. The closer you get to your credit limit, the more it will impact your credit score negatively. So keep the balance kind of as low as possible, but below 25% of your credit limit is a good idea. Keeping overall debt as low as possible is good. So I'm talking about unsecured debt, so not a mortgage. And if you keep that as low as possible, then that's great. And then probably the last thing on that is just to, there's two things. Don't apply for too many things. And I'll talk about this in a second. But the more you apply for credit in a very short space of time, the more it can impact your credit score negatively. And then you just find you get refused for credit because you've applied for so many things. And that's obviously kind of a desperation part, which is you've applied for something, been refused, you apply again and again and again. So try to avoid that where possible.
And do you mean, when you say apply for many things, does this mean across sector? So I'm applying for a buy now, pay later, applying for a store card, or are you talking about I'm applying for a credit card? Barclays has said, no, I've gone to HSBC, I'm going to XYZ.
So buy now, pay later is, in a lot of cases, slightly different because they don't record what we call a hard search, which is the application for credit. Although it depends on the type of product. So some buy now, pay later firms like Klarna, for example, they do offer longer term credit, which does do a hard check. So it's just important to know whether you're actually applying for credit. So a lot of them will refer to either a hard search or a soft search. Soft search doesn't impact your score, not seen by anyone. And that's generally fine, but obviously being careful about how many buy now, pay later things you apply for and what's affordable. But yes, of course, anything like a credit card, a loan, car finance, all of that kind of stuff is just, if you apply for it, a hard search will impact your score. And then, so the final part on this is just to take your time. So don't think, right, I need to rush out, I need to get lots of credit to build my credit score, and it's going to happen. I'm going to check it next week and it's going to be great. It's just part of, building up a healthy history takes some time. So give yourself, about 12 months. And if you follow, the kind of get the bank account, possibly the credit card, if you obviously can, have self-control and run it in the right way, then, you'll find in 12 months time, actually, you will have improved from the point you are, as long as you're making your payments on time and, nothing negative has happened during that time. And then just the last little addition I'd say is when the time comes. So, the purpose of this is at some point you probably want to access credit. You want to apply for a loan or a credit card or a mortgage. And when that time comes, I think it's really important to explore your options. And that's why I always say use the eligibility and comparison services first. Now, we have one with Experian, but there are others out there as well. And what that means is you do the search and it's a soft search. It doesn't impact your credit score, but it will give you things like your eligibility rating for lenders, including Experian has some CDFIs on there as well. But we say, right, you're eligible for this credit card or this loan, and you're 90% likely to get it, or you're 80% likely to get it. You can also be pre-approved, so you get it before you apply. And it can also, in some cases, guarantee the interest rate you pay and the limit you pay. But none of that impacts your credit score. So it's a really good way to do your search beforehand, do your research, check, the lenders you should be exploring to, rather than just saying, right, I've seen an advert on TV, I've seen this credit card or this loan, looks great, I'll apply there. And if you're refused, it can damage your credit score, and then you need to go and search somewhere else for it. And so it's a really good way to do the research, figure out where you need to apply, and then you stand a much better chance when the time comes that you do want to apply for credit.
Very useful. Thank you so much, John. We've run out of time, so I'll ask very briefly, Daniel, if you have any final thoughts, and then Shiona, I'd like you to give some final advice for clients in your specific, underrepresented community clients. But any final thoughts from you, Daniel, would be much appreciated.
Yeah, there's lots to talk about. We could talk for hours about on this topic, particularly on the credit score. But I believe the best way to improve this situation without waiting for another few decades is to adopt a new, more advanced and flexible scoring system that will enable banks like Shiona, but many others, to identify creditworthy clients among people with average or low credit scores. And Rangeteller is such a system.
Thank you very much. I think, and the other thing to talk about that is that, in my opinion, is that collaboration is key here, because there's all these drivers and it can always be supplemented, because it's going to take a whole lot of time to change a system that's been around for a very long time. But it's working with fintechs and legacy organizations to see how best we can make things more fair. Shiona, any final thoughts or advice for clients who are on the hamster wheel?
Yeah, I think obviously what John said is absolutely true. I think one of the other things as well is your bank statements. More and more people use bank statements to make lending decisions now. However, often people have maybe 4 or 5 bank statements and transfer things back and forward between them. Actually having a main bank account with your income going out and a few direct debits going out will also help, especially being able to get a yes by more automated decision makers. So actually creating a digital footprint on your bank statements as well as your credit score is important, and getting more and more important as more lenders use this information, and may help you get a lower risk acceptance and a lower APR if you do that.
Thank you very much. I think for me, the key takeaway has been around the ability to report your rents, because you may be, whether you're renting or have a mortgage or looking to get on the property ladder, you're living somewhere, hopefully. It's a different case for homelessness, of course, but if you are living somewhere and you're able to report that information, there's ways to start building your credit score from scratch, which is very encouraging, because historically it was only if you had a mortgage. So I think that's very revolutionary. It's a revolutionary start to improving what Daniel's been talking about. And so That's very impressive that Experian and the bigger players are going in that direction. So look at ways that the new things being embraced are taking on. Can you report your rent and get that going? Thank you so much. It's been a very insightful panel discussion here. I'm so happy that you could join us, and on to the next one. Looking forward to doing it again, hopefully.
Thanks for having me.
Thank you. Thank you.
Okay.
Thank you for listening to the Grow Your Money podcast. If you're looking to take actionable steps toward achieving your financial goals, visit moneymatex.com. That is money, MATIX.com. And join our free Grow Your Money Challenge. Let's unite in the movement to inspire people to talk about money. Thank you for being a part of our community. We'll see you in the next episode.